Hey tech enthusiasts, welcome to the Thursday edition of Tech Stocks Daily. Buckle up as we dive into Shopify's wild revenue roller coaster, crushing growth yet cautious guidance, a real stock market thriller. Next, we'll explore AppLovin's boost from its stellar earnings and juicy gaming division sale, despite facing some legal skirmishes. Finally, get ready to decode ARM Holdings' record-breaking revenue figures, balanced with some cloudy forecasts amidst the AI revolution. Intrigued by what these tech giants are up to? Stick around as we unpack today's tech stock saga and see who's on your investment radar. Hey there, tech fam. It's all about Shopify today, as it's making headlines and giving the stock market a roller coaster ride. Here's why Shopify is the star of the tech news show. Shopify, the e-commerce giant, just released its fiscal first quarter results for 2025, and it's got a lot of eyes watching. For those not in the know, Shopify helps businesses set up online stores, making it a major player in the digital retail space, and it just keeps on growing, which is pretty groovy. In this quarter, Shopify reported a 26.8% jump in revenue, bringing in a whopping $2.36 billion. Gross merchandise volume, the showstopper metric showing the total goods sold through the platform, hit a near $75 billion. That's like the GDP of a small country, folks. But here's the twist. Despite this impressive growth, Shopify's stock still took a hit, closing around 5% lower. Why the tepid vibes around stellar growth? It all ties back to those negative news bears. Shopify's guidance for the current quarter came out softer than expected. The company projects mid-20% growth in revenue for the next quarter, which makes investors a bit jittery as Wall Street predicted around 23% growth. Now, let's throw in some trade tensions to spice things up. Shopify's clientele consists mostly of small and medium-sized businesses. Many of them are facing uncertainties due to President Trump's tariffs on Chinese imports. Although Shopify's CFO insists the immediate impact will be minimal, uncertainty is still today's buzzword, making investors a tad uneasy. Funny enough, Shopify seems to be one of those sturdy tech companies that acts like a rubber band ball, bouncing back amidst headwinds. Its adaptability is seen in new tools like the Buy Local feature, aiming to give consumers the option to support merchants within their own country. Pretty neat, right? Standout financials include an adjusted EPS of 25 cents, just a hair's width shy of the consensus estimate of 26. Adjusted net income hit $335 million, flaunting a substantial year-over-year increase. However, its gross margin slid a bit to 49.5% from last year's 51.4%. So what's the takeaway? Don't dilemma dwell, folks. Shopify is playing a fierce game, and despite the tariff tremors, it's going strong on that growth and profitability train. The overall picture shows robust user engagement and well-managed risk forecasts, balancing itself on the tightrope of a worldwide trade landscape. So there you have it. Shopify's got it all. Growth drama, tariff tension, and strategic maneuvers to keep you entertained till next quarter. Stay tuned to see how Shopify navigates its turbulent market waters. We'll keep you posted with the latest pulses in the tech world to help keep your portfolios spicy. Let's dive into the whirlwind week of AppLovin, an ad tech company that grabbed the spotlight for several reasons. Some that made investors smile, and others that probably left them furrowing their brows. First off, AppLovin stock saw a significant boost with a hefty 12.4% surge this week. This cheerful rise was fueled by the company's stellar first quarter financial results. They reported an impressive earnings per share of $1.67, which blew past Wall Street's consensus estimate of 1 per 45s. Revenue was equally impressive, coming in at $1.48 billion, surpassing expectations and marking a 40% increase from the same period last year. The advertising segment truly stole the show, with revenue soaring 71% to $1.116 billion. But there's more to this story than just numbers. AppLovin announced it would sell its gaming division to Triple Dot Studios, giving the company a sweet $400 million injection in cash and nearly 20% ownership in Triple Dot. The sale allows AppLovin to zero in on its ad tech business, a move seen as strategically smart given that it's their fastest growing segment. Adding a dash of speculation and a sprinkle of audacity, AppLovin's CEO, Adam Foroughi, revealed interest in a potential merger with TikTok Global, excluding China. While this idea seems as likely as bumping into Bigfoot at Starbucks, it's caught the market's attention nonetheless. A merger could potentially turbocharge TikTok's revenue from its current $20 billion to $80 billion, according to predictions if one squints optimistically enough into the future. Despite all the optimistic developments, the company also found itself tangled in legal vines. The law firm Bragar, Eagle & Squire, PC, is investigating AppLovin on behalf of shareholders following class action concerns. The claims suggest that AppLovin's much-touted Axon 2.0 digital ad platform might not be as squeaky clean as it seems. Allegations include using data from Meta platforms illicitly and employing manipulative ad strategies that artificially inflated impressions and profit figures. These eyebrow-raising accusations originally caused AppLovin's stock to tumble back in February. So, what's the takeaway here? On the one hand, AppLovin seems to be on a major upward trajectory in its core ad tech business, shedding distractions like its gaming division and dreaming big about future potential mergers. On the other hand, they're also navigating choppy legal waters that call into question some of their practices. As the weeks unfold, we'll have to wait and see whether the stock continues to soar on wings of optimism or whether legal entanglements will ground some of its ambitions. Stay tuned, because with a mix like this, AppLovin is sure to keep making headlines. All right, tech enthusiasts, grab your digital popcorn and let's dive into what's cooking at ARM Holdings today. This British chip design maestro certainly made a splash in the tech news world, and here's why. ARM Holdings is catching headlines after it posted record-breaking financial figures for its fourth quarter of 2025. With revenues reaching a staggering $1.24 billion, edging past even the most optimistic expectations, they've set the bar high. But wait, that's not all. ARM didn't just beat prior figures, they've leaped into tech glory with licensing revenues up by a staggering 50% year-on-year to $634 million, and royalties growing 18% to $607 million. Now that's a standing ovation performance. These figures weren't enough to keep their stock afloat, interestingly. Why? Future guidance threw some cold water on the hype. ARM offset its Q4 dazzle by projecting gloomier times ahead. They're forecasting a fiscal 2026 earnings range between $1.56 and $1.64 per share, collaring past analyst estimates of $2 through $3 per share. Talk about a plot twist. Part of the plot involves the dark cloud of indirect tariff impacts looming thanks to the infamous US-China trade tensions. While ARM CFO Jason Child confidently stated they're shielded from direct tariffs, those are slapped on products, not services and designs like ARM's, the story isn't over. A chunk of their royalties comes from US shipments, making them susceptible to trade gusts just when you thought their sales were safely hoisted. Adding some coder confetti, CEO Rene Haas exclaims the crucial punchline: AI is changing everything, and you can't run AI without ARM. He's popping the AI champagne and projecting the company's increasing penetration in data centers, with up to 50% of new hyperscale server chips expected to sport the ARM badge. Could it be ARM's secret sauce for tech resilience in a field tackling economic uncertainties? Despite a killer Q4 celebratory dance, ARM didn't dish out a full-year financial forecast. Analysts yanked on this uncertainty, making downward adjustments to their target prices given fiscal forecasts, and Gwydless Future wandered like a free-spirited AI bot without purpose. All said and done, ARM stole a moment in today's tech spotlight, with both applause for their recent accolades and curious whispers about their long-term voyage. Their stock took a tumble, with market players cautiously playing side quests amid mixed signals. Now I want to hear from you, our wonderful viewers. Are you adding ARM to your watch list or keeping it in your digital peripheral vision? How do you think AI and tariff storms could shape ARM's journey? Hit up those comments below and let's digitally chit-chat about ARM's tale. What do you make of ARM's current performance and outlook? Grab that keyboard and share your sharp insights. Stay tuned, keep your tech spectacles polished, and let's keep exploring the wondrous world of technology together. Your thoughts truly shape our tech universe. All right, let's zoom in on Shopify, the e-commerce powerhouse. Imagine you're cruising through the stock market and you spot Shopify, glittering with loads of potential, even amidst its current hiccups. So what's the move here? Buy, hold, or sell? Given today's report, where Shopify's stock took a bit of a dive despite stellar growth numbers, I'd say the play here is to hold. Let's check out the reasoning. Shopify crushed it with a 26.8% revenue bump this quarter, hitting that sweet $2.36 billion mark, and let me tell you that gross merchandise volume is packing some serious muscle at near $75 billion. But the jittery feelings resulted from guidance forecasts that didn't satisfy Wall Street's aching curiosity for explosive growth. Couple that with looming anxiety over trade tariffs involving Chinese imports, and for sure, Shopify's got short-term obstacles on the track. However, Shopify is no rookie to weathering economic storms. Their ability to adapt, like rolling out the Buy Local feature, showcases innovational zest, a sound reason why this tech rubber ball bounces back so gracefully. By holding, you're essentially betting on Shopify's long-term potential. The company is still fundamentally sturdy, showing resilience with year-on-year profitability increases and keeping innovation at its core. Trade tensions are tough cookies to crumble, but Shopify is an adept player in a continuously evolving game. Remember, folks, this decision hinges on my read of the market turbulence and Shopify's promising resilience, but it shouldn't throttle your individual analytical engines. Always wield your own financial magnifying glass before deciding how you want to play. Hold the line and see how Shopify masters its ups and downs. So tech trailblazers, hop in those comments and let me know. Would you hold, or are you planning a different financial choreography based on today's Shopify roller coaster? Let's polish those crystal balls together. What a day on the tech roller coaster, folks. We watched Shopify take us on a loop-de-loop with stellar growth but cautious guidance, AppLovin flying high despite some legal potholes, and ARM dazzling with record revenues yet cooling forecasts. It's like watching a sci-fi thriller unfold. If today's tech drama made you think, laugh, or maybe even scratch your head a little, go ahead and give that like button a nudge. Subscribe for all the latest updates, and share the fun with your fellow tech enthusiasts. Make sure to circle back tomorrow, because we'll be diving into another tech escapade that'll keep your digital gears turning. Catch you all in the next one.